Hello, welcome friends. Today I am going to discuss about journal entries. Journal entries, its concept, rules of debit credit. After watching this video, no one will be unknown about the rules of debit and credit. They will be able to solve every type of journal entries. Without getting delay, I am going to start the presentation. Journal entry. What is journal? All the transactions of a business are recorded first in the book of original entry as and when they take place. Such book of original entry is popularly known as journal. Journalizing. The act of recording a transaction in the journal is called journalizing. It is the process of identification of the transaction, classification the account, and applying the relevant rule of debit and credit. Preparation of journal. The journal is prepared in following format. The format is as follows. The first one, the date column. The date column is meant for recording the date of the transaction on which it takes place. In this column, the date is written in chronological order. The next one, particulars. Particular. This column is meant for recording the account to be debited and credited. The name of account to be debited is written in the first line. The word DR is written after the account name. The account to be credited preceded by the word to is written leaving a few spaces away in the next line. The brief explanation about the transaction known as narration is also written below the line giving credit to the account. The narration is enclosed by the bracket starting with for or being. The next one, LF or ledger folio. The LF stands for ledger folio, which means the page number of the ledger where the entries are posted. The next one, the debit. Debit amount is used to write the amount to be debited against the debit account. And the last, credit. Credit column is used to write the amount to be credited against the credit amount. At last, the total of all the transactions are summed, debit sum and credit sum. The debit sum is always equals to the credit sum. Rules of debit and credit. To record the transactions according to the double entry bookkeeping system, the following two approaches can be applied as the rule for debit and credit. The first, on the basis of type of account, it is also known as traditional method. The next one, on the basis of changes in assets, liabilities, and the capital. This method is also known as the modern approach. Let's start one by one. On the basis of type of account, under this approach, all the transactions are first classified into three account groups. They are personal account, real account, nominal account. Personal account includes Harij, Sitaj, Ram, Sam, whatever the name is mentioned, and XYZ company, capital, etc. The real account includes cash, bank, machinery, furniture, land, building, anything tangible and intangible assets which worth for the business. The last, nominal account. It includes expenses, losses, incomes, and gains incurred by the business. Personal account. Let's see one by one the all account. An account which are maintained for whether natural or artificial means legal person are called personal account. Natural person represent human being and artificial or legal person include different types of firm like partnership firm, companies, institution, etc. The Ram's account, XYZ company's account are the example of such personal account. A person who enters into a business transaction with a business either receives some benefit from the business or gives some benefit to the business. The rule for personal account is debit the receiver, credit the giver. Who is receiving the benefit, he is debited, and if someone is giving the benefit to the business, he is credited. Here are some examples of personal account. The first, Ram started business with cash. In these examples, I am just dealing with one single account, only the personal account. Even if the journal entry is completed by dual effect, two side debit and credit. I am only discussing about the personal account, only one account. Either the debit or credit will be left in this example. Here, in the first example, Ram started business with cash. Here, the related personal account is capital. As the rule is here, credit the giver, a business, the capital is given to the business, the capital is credited here. The next one, goods purchased on credit from Ram. Here, the related personal account is Hari, and Hari is giving goods to the business, goods purchased on credit from Hari. So Hari account is credited. Whatever the debit transaction occur, but Hari's account, the personal account in this transaction is credited. The next, goods sold to Sam on credit. The related personal account is Sam here, and we are selling goods to Sam. Sam is receiving something else. So according to the rule, debit the receiver, we are debiting Sam account. Loan taken from the Ramesh. We are taking some loan from the Ramesh. The related personal account is Ramesh here. So Ramesh is giver to the business. So Ramesh is credited. Goods returned to Hari. Hari is the related personal account here, and Hari is receiving some goods from, so Hari is debited. The next, loan of Ramesh paid. Here, the related personal account is Ramesh, and Ramesh is debited here because Ramesh is the receiver. The next, real account. The account of those lifeless things which really exist with monetary value are termed as real account. Generally, real accounts are accounts of goods, properties, assets, or things owned by the business, and using these, the business is carried on. Real accounts are of two types. They are tangible, they include cash, machinery, land, building, furniture, etc. The next, intangible, they may be trademarks, copyright, patent right, etc. Real accounts either come into the business or go out from the business. Hence, the rule of real account is debit what comes in, credit what goes out. If anything comes in the business, that is debited. If anything that is going out from the business, that is credited. More detail, we are being clear from some examples here. Ram started business with cash. We had seen the same example in personal account also. Here, related real account is cash. Cash is coming in the business. So in this in out, I have mentioned here in, and the cash account is debited here. Cash account debit to capital account. Furniture purchased. In this example, the related real account is furniture account, and furniture is coming into the business. So furniture is debited here. The next, goods sold to Sam on credit. Here, the related real account is goods. Goods is going out from the business and goods is credited here. Loan taken from the Ramesh. Here, the related real account is cash. As we take loan, we get cash. Cash is coming into the business and the cash is debited here. The next one, goods returned from the Sam. Here, related real account is goods account. Goods is coming into the business and we debit the goods. Goods returned to Hari. Here, related real account is goods account and goods are going out from the business, so goods are credited here. The last one, loan of Ramesh paid. As we pay loan to the Ramesh, related real account is cash and cash is going out from the business, so cash is credited here. Nominal account. Nominal accounts are also known as fictitious account. These are the accounts of expenses and losses incurred and income and gains earned by a concern. These accounts are called nominal account because they exist only in name. They cannot be seen and touched. They do not really exist. Salary account, commission account, wages account, etc. are some of the examples of nominal account. Rules of nominal accounts are all expenses and losses are debited and all incomes and gains are credited. We can see it here in the examples. If anything expenses we incurred or any losses we bear, the business bear, that losses or expenses are debited and any type of income or the gains are credited. We will be more clear about the nominal account by following examples. Commission received. It's the commission is received. Here the commission is the nominal account. So commission is credited here. As commission is received, we get some cash. So cash is debited and commission account is credited. Discount allowed. Here, related nominal account is discount and discount allowed. This is our expenses and as it is the expenses, it is debited here. Electricity charge paid. Here, the expenses is electricity charge or electricity expenses. It is debited here. Stationery purchase. Stationery purchase is the expenses and the related nominal account is stationery account, it is debited. Salary paid. The related nominal account is salary account, it is our expenses and it is debited here. Dividend received. Dividend received. Here, related nominal account is dividend and dividend is a type of income for us. As it is the income, it is credited. The last one, discount received. Here, the related nominal account is discount. We have received discount. Receiving discount is a type of gain, so it is credited. Now, the next pattern, next type of rule on the basis of changes in assets, liabilities, and capital. Under this approach, the effect of each transaction are analyzed using the principle of accounting equation. For this approach, all the accounts are grouped into the following 5 categories: asset account, liabilities account, capital account, income and gain account, expenses and loss accounts. Asset account. Asset account may be tangible and intangible things that have value. It may be cash, bank, plant, machinery, furniture, land, building, etc. Liabilities. Liabilities account may be payable to by the business. It is any type of payable by the business. It is the due or outstanding expenses. Capital. Capital account is the first initial capital, after that additional capital. The next one, income and gain. It is any type of income or gain received by the business. Some of the examples are interest received, dividend received, discount received, commission received, etc. The last, expenses and losses account. Any expenses incurred by the business firm. Any losses incurred by the business firm. Some of the examples are salary, wages, stationery, discount allowed, losses by fire, losses by theft, etc. Here, the rules of these five types of accounts are: at first, for assessed account, it is debited if assessed are increased. It is credited if assessed are decreased. For liabilities account, it is debited if liabilities decrease. It is credited if liabilities are increased. Capital account, capital is debited if it is decreased. Capital account is credited if it is increased. Income and gains account, it is debited if it is decreased, and it is credited if income and gain are increased. Expenses and losses, it is debited if expenses and losses are increased. It is credited if that is decreased. These are the rules of debit and credit on the basis of changes in assets, liabilities, and capital. If you are not familiar with personal account, real account, and nominal account, you can also learn the rules of debit and credit by the changes. It is easier to classify all the transaction into these five categories as assessed, liabilities, capital, incomes and gains, expenses and losses. Furthermore, we will be more clear about the changes in assets, liabilities and capital by the following examples. Business started with cash. When business started with cash in the business, cash increases and as well as capital increases. As per our rule, the last scene we had seen, cash is assessed and cash is debited when it increases. And the next account is capital. Capital is credited as it is increases. So capital account credit. The next example, cash paid into bank. By this example, bank account or bank balance increases, cash decreases. Bank account increases, so bank is debited. Cash account decreases, so cash is credited. Furniture purchase. By this example, furniture is increase in business and cash is decrease in business. Furniture is increasing, so furniture is debited. Cash is decreasing, so cash is credited here. The next, stationery purchase. Stationery, while purchasing the stationery, it increases expenses and decreases cash. When expenses are increases by the rule, we debit the expenses. So stationery account is debited here, and as cash is getting decreased, we are crediting the cash. Interest received. Here, the affecting accounts are a cash account and income account. Cash is increasing as well as income is increasing here. When the cash is increased, it is debited. When income is increased, income is credited. So interest is credited here. The next one, loan taken. When the loan is taken, the cash increases in the business and liability also increases in the business. When cash is increased, cash is debited here. As the liability increases, loan is credited here by the rule. Salary paid by the check. When we pay the salary, expenses is increasing as well as bank balance is decreasing. As expenses increases, it is debited here, salary account is debited, and bank account is getting decreased. By the rule, bank account is credited here. To be more clear about this debit and credit rule, please go back and see the last slide of 5 account. At last, I am giving some core of rule of debit and credit. The first was by dividing total account into three different accounts, is personal account, real account, and nominal account. In personal account, the rule was debit the receiver, credit the giver. In the real account, debit what comes in, credit what goes out.
For nominal account, all expenses and losses are debited, all incomes and gains are credited. Furthermore,
in account, by classifying transaction into different 5 accounts, is assessed, liabilities, capital, incomes, and gain. Let's see them all of them one by one. When assessed increases, it is debited. When assessed decreases, it is credited. When liability increases, it is debited. When liability decreases, it is debited. To make more clear, I have mentioned all the decrease by red sign here, and here all the debit by yellow and credit by red sign. The next one, capital. When capital increases, it is credited. When capital decreases, it is debited. When incomes and gains are increased, they are credited. When incomes and gains are decreased, they are debited. The last one, when expenses and losses are increased, they are debited. When they are means expenses and losses are decreased, it is credited. By either of these two rules, we can solve the journal entry, whether this one or this one. Please be confirm in one rule. Do not try to solve both of the rule, even if both of them are related with one another. I think now you can solve the journal entries. I have been able to make you clear about the rules of journal entry, the rules of debit and credit. Thank you for watching till the end. Thank you very much. Happy learning.